Hello, everyone, and welcome into CrushTheStreet.com. I am Kenneth Amaduri, and today we have a timely discussion, we're going to have a timely discussion with Gwen Preston of ResourceMaven.ca. She's got powerful insight on the economy, but more importantly, mining, and she provides independent analysis of the resource markets, and today she's going to shed some light on all of this for us. She's a returning guest, Gwen Preston. Thanks for joining me.
Thank you very much for having me.
Gwen, since the beginning of the year, it's been quite a moonshot for some of these miners, 100%, 200%, 500%, 800% in some cases. And, here at Crush the Street, I've been telling people precious metals are essential going forward, in this unstable economy. And the miners offer that leveraged upside. Obviously, we haven't seen 100% move in gold or, even 100% move in silver, but we've seen these in the underlying mining shares. But this summer has shown to be, a correction period for some of these miners as of the last couple weeks here. So I want to ask you about the dynamics of, what we're seeing in the summer and kind of the cyclical nature of what we might be going into in September and into the fall.
Absolutely. Those are sort of the questions on everybody's mind who's interested in investing in this sector right now. So yes, clearly miners made huge moves off of gold's 25% gain. That happened in the first half of the year. And we absolutely saw miners double, triple, quadruple. And we did see a fair bit of the classic order of events, which is that the first to go for those who are already in production, the sort of safer go-to producers. A bit of an interesting thing there were some of the mid-tiers outperformed the majors, which was different from the classic playbook, but that's largely because the majors are still more burdened with debt. Like their balance sheets are not as strong as the mid-tiers who were able to repair those balance sheets better during the bear market. So we saw a bit of an interesting dynamic there. But regardless, anybody who was had gold production or silver production of reasonable size, their share prices went crazy, to put it bluntly. And then we saw that investor interest move down, and we saw, companies with development stage assets start to really get interest as well. And then we saw exploration stage companies, at least the explorers who were active in doing something. There's a lot who are still just figuring out how to get out the door because they were bereft of money for so long. But those who were active started getting all that interest as well. And we've seen it, I can point out a bunch of exploration stocks that are up sixfold on the year. So we did get the classic move, which is producers followed by developers, followed by explorers. And then, then summer comes, and things have been mostly sideways since the summer. So what does that mean in the big picture? My view is that we are in a gold bull market. We have the fundamental arguments for gold are very strong. On a relative basis, it's still inexpensive, and in a broad context of where to put money that is both somewhat secure and offers upside opportunity, gold stands out. We're sitting in a world that's awash in negative interest rates, negative real rates. We're looking at U.S. stock markets that are expensive. Whatever you think is going to happen with those U.S. stock markets, the valuations are very high. We're looking at global economies that are pretty stagnant. Not terrible, but certainly not outperforming by any stretch. It all really adds up as a perfect storm for gold. So in general, we're still in a gold bull market, in my estimation. This summer is absolutely been a bit of whether you call it a correction, whether you call it a consolidation, doesn't really matter. Bull markets are made of higher highs and higher lows. So the low part happens, even if we enjoy the seemingly endless ascents better, those ascents are punctuated by setbacks. And summer is a very common time for that. And it's almost perhaps a bit more marked near the beginning of a gold bull market because a lot of the a lot of the money that comes into play when gold turns is people who are really engaged with the sector. So long-time gold investors who've been waiting for this turn for the last 4 years. Those of us who work in the industry who have also been waiting and know what this kind of turn can mean, right? That there's going to be some really nice share price moves, so let's get in and let's get a hold of those after all these years of waiting. So a lot of it's a fairly small group. It's a very dedicated group, and that money moves in. And then literally people go on vacation in the summer. And people have, to a large extent, when I was chatting with friends in the industry in June, a lot of people had deployed most of the capital that they had available. And so there's profit taking. There's going to be a bit of profit taking when share prices, when your portfolio is up 300%, of course you're going to sell a little bit. So that's all part and parcel of how this works. Now we're sort of through the summer. Labor Day's around the corner. How the fall's going to play out will be really interesting. So we just had Janet Yellen come out and sort of stay the course as much as anything. My sense is that an interest rate hike is off the table until after the election. No guarantees there. It might rise. They might put it up in September, but my sense is that they won't. And either way, gold can still perform even if she does raise 25 basis points, because at the end of the day, that doesn't really matter. So there's a few interesting factors that will come into play in the fall. One of them is gold's regular seasonality. So gold having come off, the price having come off through the summer, might actually help it perform in the fall. The fall is always a strong season for gold, and that's driven by physical buying, primarily in India and China. So in India, it's the wedding season, and that's really gold that encourages a lot of gold buying. And in China, it has been driven by sort of a conservative money approach. Get through the year, harvest, literally physically harvest your crops, get money in the bank, and then once that's all done, go out and put some of it into gold and then hide that gold away under your mattress or wherever it might be. Lower prices encourage those groups to buy more gold. So gold having come off a bit this summer might encourage more buying from those groups in the fall. So India's actually not been buying very much as gold increased. It's 25% because they're like, it was so cheap for so long. But they might be encouraged to come back into the market a bit more. So the fall will be pretty interesting. I think we're going to see the gold price rise between Labor Day and the end of the year. The amount of that rise, I don't know. I'm pegging 1,400 at the end of the year, but only time will really tell. There's some other interesting aspects coming into play for the stocks. Those stocks will continue to offer what you described, that leverage to the price move, right? So we saw 300% gains on 25%, but then we see that to the downside as well, right? We've seen that through the summer to the downside.
And even guys like George Soros now are taking some money off the table and taking some profits off the table with his recent news selling Barrick, his position in that. An interesting thing, just before we move on, an interesting thing with that is that George and some of those guys, some of those major investors who've been quite outspoken about their gold moves, that's been very significant. That kind of talk can really help the generalist investor remember that gold goes through these cycles. A lot of generalist investors have participated in a gold bull market before, even if gold is just one of the many things that they own. When gold goes, they get in, they make money, and they remember. So gold momentum kind of feeds itself because of that history of people having made money. The other interesting thing there is there's a lot of money out there in large funds where I'm hearing a lot more that those funds are interested in getting into gold, but the bigger the fund, the slower any change in direction actually happens. Think of it as like a massive ocean-going freighter. And if it wants to turn a corner, it takes forever. First, it has to actually make the turn. Then it has to regain momentum and actually start moving forward in its new direction. So these funds are really slow to make a move. The bigger the fund, the slower it goes. And they have difficulty finding enough capacity, enough room in our tiny little mining sector to shove their hundreds of millions or billions of dollars. Right. So it takes a while. So that money is still there. And as long as gold does, make some positive moves in the fall and regain some return, perhaps what might be a little bit of missing confidence right now in the overall bull market, then those funds will still come in, and that's a lot of fuel that's left that hasn't yet been put on the fire. Actually, I do want to touch on something related to this, and that is the revaluation of the mining sector. And it's actually rather interesting because if you compare the market cap of Apple or Exxon or Amazon, any one of these three companies have a larger market cap than the entire market cap of the mining industry. And
I know, it's amazing.
And I want to ask you a question on this. And I was on an interview of Bill Holter on the SGT report. He points something out that indicates explosive upside for the companies that have proven resources, proven ounces in the ground that aren't necessarily selling it at the moment, like some of these producers are, but the ones that will be able to sell it at a much higher gold or silver price for that matter. And I just want to get your thoughts on this. This sector could be massively revalued if we do see a much higher gold price, which I tend to believe we are going to see.
Yeah, it's interesting to think of that sort of big picture valuation. So what's the sector overall worth, and how dramatically could that change? I don't spend a lot of time thinking about it because it's so difficult. The predictions for what the gold price might do in the next year, let alone in the next 10 years or so, cover such a wide range. But yes, there is a lot of argument out there for a considerably stronger gold price, right? If we're at $1,310 right now, like $2,000. I mean, we almost got there a few years ago, so that seems pretty reasonable. I mean, and that's a big change from here. And then there's lots of forecasts that are significantly above that, right? So yeah, that would absolutely change the valuation of the sector as a whole. There's a few interesting things about that. One, in the last gold bull market, as the price of gold ran up, producers got really excited, and then they got in this race to produce more and more and more, which sounds good until you realize that they let their costs creep up and up and up with that. So their profits weren't actually any better than they were when gold was worth less. So that negates, or at least diminishes a lot, the ability for the sector to increase it, to add in value a lot, right? So we would need the sector to show much better profits with an increase in gold price, not just much higher production. So hopefully the sector learned its lesson in the last bull market, and we will not be going for more is better. We will be going for more profit is better, not just more ounces.
Yeah.
So that part's interesting.
Well, that takes away from the whole underlying leverage in the mining industry. For each dollar that gold goes up, as investors, you're hoping that's going straight to the bottom line and not being added to the cost of production, at least largely.
Absolutely, yeah, and that certainly was a plague upon the last bull market. Was that was not how it went. Was that costs really climbed. So that's one consideration. As for this gold in the ground versus gold being produced question, there's a lot of people playing that game right now. So there's a lot of companies that got started sort of at the end of the bear market and, called themselves optionality plays and just started assembling portfolios of projects with established resources in the ground. The business plan being to not really do a lot with those projects. Maybe do a bit of exploration or some permitting work or whatever it might be, depending on the company, but not to do a lot. Primarily just to hold those projects based on the fact that these companies think that the gold price will be much higher in a few years, and therefore these assets will be worth a whole bunch more than what they bought them for at the end of the bear market. So there's definitely people playing that game. As for how an investor should play it, it depends on your timeline. At the beginning of a gold move, the first companies to go are those who are already producing or who are about to produce, who have, mines under construction, whatever that might be. So that offers the the immediate leverage to gold's move. If you have a longer time horizon, then perhaps it makes more sense to sort of think of that slightly bigger picture and what's the very best way to capitalize on, gold leverage over whatever your time frame might be. it's probably the best is probably a mixture to get some exposure to all the different stages of the game, especially because mining and exploration is an inherently risky game, and a lot of projects don't work, so you don't want to put all of your eggs in any one optionality basket, as those plays are being called these days. But it certainly is an interesting question, and there's a lot of talk about that issue in the industry today.
Gwen, I want to get your thoughts on uranium here. This has been a commodity that would clearly still be dealing with the legacy effects of Fukushima depressing the uranium prices even until today. And we are seeing uranium prices at around $25 a pound, prices we haven't seen since 2005. And talk about a subsector of the mining industry that has not been catching a break in this bull market. And it's really a shame for the producers, like we were talking, to have to sell their inventory at such depressed costs. So I'll just start you off with this. How long can this go on for?
Oh, such a good question. I love uranium. I really believe nuclear in uranium as a fuel for the future, as a clean energy source. And I really believe in the fundamentals of uranium, that the price has to increase. So right now we're looking at more nuclear reactors either in operation, under construction, or planned around the world. Today there are more than there were before Fukushima. So yes, that disaster absolutely had a really significant impact on the market that persists today. And there were nuclear reactor plans and operations that were suspended because of it. We are generally past that in terms of the operations side of the sector, in terms of what reactors are doing and what countries are planning to do in terms of incorporating nuclear into their energy plans. The thing that hasn't responded yet, or that hasn't, gotten back on track yet, is the uranium price. And the contrast between those two things means that we're looking at 2019 as where the world no longer has enough uranium to feed operating reactors. And in order to fix that, we need new projects. But there is not a new project in the world that is even close to economic to build at $25 uranium. It's not possible. Even the very lowest cost in situ leaching projects don't make sense at $25 a pound. So the price has to move. How and when that will happen? Right now we're looking at a bit of a standoff. So those who operate nuclear reactors, the utilities, usually cover their uranium requirements at least 3 years out. They make sure they've got enough contracts to feed their reactors for at least 3 years, often more, because you don't mess around with risking running out of uranium for your reactor. That causes a nuclear meltdown. You don't go down that path. But there's been so much excess uranium available in the spot market because of Japan not consuming its uranium over the last few years since Fukushima. The utilities have had an easy go of it. They haven't been so concerned if if their contract supplies aren't enough to meet demand. There's available uranium on the spot market. They've been able to get it. That's been working till now. At some point, though, these utilities, they're looking at the same supply-demand charts that I'm looking at, and they know that crunch is coming. So at some point, a utility is going to blink, and they're going to say, okay, we've had it easy peasy for long enough. That's been great, but we need to make sure that we're not the ones left in the lurch when that supply gap hits. So they're going to sign a new contract, for a new long-term supply contract with a producer. And a producer isn't going to be able to get exactly the price they want, but they're certainly going to get a stronger price than spot by quite a bit, because it wouldn't be worth their time to produce it for less. So when that standoff starts to come to an end, that's when the uranium price is going to start to move. I don't know when that will be. Sometime in the next 12 months is my take on it, but I wish I had more confidence on a timeline. What else is the other thing that's interesting, though, is I have been sort of bouncing around on stock charts of uranium explorers, and they're kind of inching up really slowly. I mean, the the gains don't look very dramatic next to if you go back and forth between gold stocks and uranium stocks. But you look at some uranium stocks, and they're over the last 3 months, they're up 10 or 15%, and it's quite a consistent thing across the board. So that means that speculators are thinking along the same lines that I've just described, and are perhaps starting to position. Does that help in the long run? I'm not totally sure, but it was an interesting phenomenon that I just acknowledged a few days ago.
Gwen, could the uranium sector have its own bull market without gold and silver? You know, let's say the gold and silver, junior mining sector has its own, just like we're seeing, bull market rally, this bull market trend here, and then maybe suppose the price turns around when that ends. Is the uranium sector going to be dependent on the funds that are coming in to the mining sector that we're seeing, because of gold and silver's rise? Is it dependent on the rising commodity prices in general, or can it have its own day in the sun?
That's a good question. I think it can have its own day in the sun, largely because it's an energy market, right? The other metals feel more tied together. Base metals certainly feel tied together because they're an industrial commodity. Precious metals are tied together because they're related to global investment situations. But uranium is an energy commodity. So from that sense, it can move independent of other mined commodities because it's feeding a different requirement. At the end of the day, mining bull markets do best when they're multi-commodity rallies. So right now we've been looking at the gold-silver bull market. The best case scenario going forward for mining investors and mining companies is that, is that other commodities join the cycle. And that's what we've seen in the best cycles historically. It often starts with gold and silver, and then you get other commodities joining, whether it's copper. Right now, zinc is doing really well, so zinc could join. And then maybe uranium could join. And then you often get some, so to say, strange commodity also having its little boom in the middle of it too, right? In 2006, we had rare earth elements go for a run. Right now, lithium is probably the one playing that role. So yeah, multi-commodity rallies are definitely the best, but uranium can absolutely go on a run on its own. That run won't be as strong as it would be if it's within the context of a broader mining bull market, but it can happen on its own.
Gwen, I want to ask you your thoughts on lithium. You just brought that up, and it's been one of the hottest commodities over the last few years, and especially notable with what we're seeing with Tesla and Elon Musk opening up the Gigafactory. Some are calling lithium the oil of the 21st century. What are your thoughts on lithium?
Lithium is an interesting one for sure. I have a lot of thoughts on lithium. I'll try and be brief. So lithium has offers a lot of allure that a lot of other mined commodities don't offer, right? So it's a green commodity because it's helping us be more environmental in our energy usage, and the mines can often be a little bit more environmental in themselves as well because they're mining a brine instead of a big open pit hard rock operation. There are those as well, but so it's an interesting commodity because it's different. So lithium demand is absolutely set to outstrip supply in the next 10 years. If you use the sort of middle of the road or leaning on conservative estimates for electric vehicle proliferation, there's not enough lithium to feed those batteries. Elon Musk is absolutely important in that. More important by orders of magnitude is China, which is really pushing electric vehicles because they're obviously choking themselves out with pollution, with smog in their cities. So this is really happening. There's a lot of countries in the world that have rebates or various benefits if you can get electric vehicles. This is pushing forward, and there's not enough lithium. Lithium is an interesting market because it's an oligarchy. There's 4 companies that produce over 85% of the world's lithium. It's very controlled by these 4. They can increase output Most of them have constraints on those increases because of permitting issues, water issues, various social issues in the areas where they're operating. So they can, but they can't. In other words, we do need new lithium production, for sure. What does that mean for the investor looking at the lithium space? Well, there's a lot of companies have debuted or changed their name, whatever it might be, in the last 6 months to put lithium in there. Or they've put out press releases saying that they've picked up a prospective lithium property. Don't believe any of it. I mean, it's a lot like the uranium bull market that we had 10 years ago. There were hardly any uranium geologists in the world who could actually find a real uranium deposit. Similarly, there's hardly anyone out there who knows how to find, and then more importantly, develop and operate a successful lithium operation. So if you want, there's a bubble happening in lithium. Most of the companies in that bubble will rise and fall just with the bubble. They will not create any lasting value. Their share prices will go right back down to the bottom. A few within that crowd will create real value. So they're legitimately developing assets towards production, and that value will come either from one of those four majors taking them out, or them potentially actually getting their project into production. So I would say, if you want to play lithium, make sure that the company that you're looking at is a legitimate player. And probably the first place to start with that is by looking at the people. Do they have people who have actually built lithium operations before, or successfully explored for and developed lithium projects? And if they don't, then walk away.
Yeah, it's good advice right there, Gwen. Gwen, we've seen mine closures take their toll on, the metals, specifically base metals, and largely silver. And I want to ask you about silver here. With some of these mine closures, we've got Lachine, Century, Glencore curtailment, some of the biggest mines in the world closing down. And I want to ask you here, silver has that monetary aspect to it, but also that supply-demand aspect going forward as well. And is it just the perfect combination, the perfect convergence of events for silver to have, a massive rise in its price?
There's definitely people who would agree with you. People who love silver really love silver. And it's for exactly the reasons that you just mentioned, because it's got the duality of appeal. It's got that financial aspect, and it's got that actual industrial usage. Silver certainly went through a phase there where it outperformed gold in recent months. It often plays out that way, so gold will move first, silver lags, but then its increases are bigger. Of course, that leverage cuts both ways, so now silver has come off considerably more than gold has come off. And the silver stocks have come off more than the gold stocks have come off for the losses that those two metal prices have taken. What's silver going to do going forward? I mean, I'm fairly bullish on silver as well. I would say it, like so many other metals in the last 5 years, not a lot of projects have made good progress. So yes, supplies are a bit questionable. It's not the same as some of those mines you were mentioning are really the zinc operations. So zinc has a much stronger, zinc and uranium, I would say, have very strong supply-demand arguments. Like the arguments behind those uranium and zinc are really fundamental. There just isn't going to be enough metal produced to feed demand. With silver, I don't necessarily see that gap as strongly, but if we do get that financial fuel, so if gold is going and this, the move into diversifying or strengthening your portfolio by having, precious metals in there, if that really continues to build, then yes, it is a bit of a perfect storm for silver. Helped by the fact that silver is used in a lot of technical applications that are more on the environmental front, so electricity applications, those needs are rising as well for the silver in the silver market. So, yeah, I would say actually just in my letter last week was pointing out silver's decline in the last month and pointed out a bunch of silver producers and explorers that have come off a lot and said, if you don't have silver or silver producers in your portfolio, right now is probably a good entry opportunity. If you missed it 6 months ago, better to get in now. Get in now because this is providing a good chance.
Right. Well, and I bring up those mines because, we know that 2/3 or whatever it is of silver production comes, as a byproduct.
Is byproduct.
That's why I did bring up those mines. And I do want to ask you, kind of talking about the opportunity in a conclusion here in the mining sector, and something you've pointed out is that the TSX Venture Exchange is actually up 77%. This year since January, and largely due to the miners that are in the TSX. But you know what? When you look at a long-term chart, it's still significantly off its high. And, actually something I would point out that, you were bringing up is, silver just going back to its high at around $50 has more upside than gold going back to $1,900. And to me, that's very bullish. But getting back to what I was saying here about the opportunity, I just, shed some light on where we are today, for people looking at what we've seen, with the miners moving up, how much upside is there still to be had just for gold and silver to go back to where they once were, not even talking about if they go beyond that?
Absolutely. It's a very good question. And what you just described with that, zoom out on the chart picture that you painted, that's what I've actually been doing a lot of and counseling people to do a lot of. If you look at 1-year charts right now, it looks like entering is scary because the gains have been so significant over the last 6-8 months that it looks, oh my gosh, am I too late? Did I miss it? It doesn't look so good. But yeah, zoom out, look at the 5-year chart, look at the 10-year chart. Like, these cycles last longer than a year, and because of that, we're still in sort of the first inning of this game. So yeah, look at the metal prices is one way. I love what you just pointed out about how silver to regain its $50 level. That we're looking at 2.5 times yet just in the price of silver, let alone what that might translate to for silver stocks that offer the leverage that we've been discussing to that price gain. Gold producers as well. And then in addition to that, I mentioned before there's a lot of companies that ended the bear market still pretty much in hibernation, right? Like, the bear market lasted a long time. Companies didn't have any money. Basically, people stopped paying themselves, shut things down, and waited for it to be over. A lot of those companies are still just getting going again right now. These are more exploration companies, but they also include good management teams that were waiting for the market to turn before they re-engaged with opportunities. Some of these stories are really just debuting on the sector now, so they haven't already had their triple that a lot of explorers have had, because they're just listing, or they're just renaming, or they're just, doing whatever their first steps are in getting going. So there's some really great opportunities that haven't even moved yet, and yet that still offer that significant upside that remains for the sector in general. So broadly speaking, I'm telling people, if you're holding gold stocks, if you're holding silver stocks, sell now if access to capital is part of your question. Like, if you need access to capital, absolutely, you can sell some of your stocks that are up nicely. Taking initial capital off the table is a great way to lower your risk profile. That's great. But don't sell because you think that the run is over, because the run is not over. These stocks will continue to go up. So you only want to get out if you want to access capital that you want to redeploy into some of these earlier opportunities, the new companies that are coming out that haven't played the game yet. Otherwise, we're in for a significant ride up yet from here. And yeah, the difference, if we're going to just regain, even just the 2008 highs, let alone the 2011 highs, we've got a lot of ground left to go. It's exciting days.
And Gwen, something I point out to people too, especially for people who haven't taken the opportunity to invest yet, it's almost a blessing because you could have been buying with us in the bottom of in 2014 when gold and silver hit their bottom, or the bottom we had in 2013, or the bottom we had in 2015 here. Of course, that really was the bottom, but for everyone that was buying at those points, I mean, that was catching a falling knife. And now we have this confirmation of the bull market, kind of behind us. And we can kind of enter these trades with a little more confidence that, we're likely not going to see what we saw during the bear market, but we're in that bull market trend here. So just closing thoughts here, and also please share with everyone where they can find your work and what they'll find.
Absolutely. Yeah, just to add to what you just said about we're no longer in a catching the falling knife scenario, the risk is a little lower because of that. It's also lower because the only companies that survived the bear market are fairly good companies. But to be honest, the only explorers, developers, producers who are out there and active and doing things right now, they're the better companies. So even from a stock-to-stock perspective, the risk is a bit lower right now because it's the survivors. And they earned that, that designation. So yeah, it's really exciting. So I write a resource investing newsletter. It's what I'm buying, what I'm selling, and why I'm doing it. It's a subscriber-supported publication. If you want to take a look at it, my website is resourcemaven.ca. You can sign up for a free trial there. It comes out every week on Wednesdays, and I really enjoy writing it. It's a really exciting sector to be a part of right now.
Well, you're extremely smart, and your insight was greatly appreciated here at Crush the Street. Gwen Preston, everyone, of resourcemaven.ca. Gwen, thanks again for coming on the show.
Thank you so much. It was great. Still in a gold bull market, in my estimation. This summer is absolutely been a bit of whether you call it a correction, whether you call it a consolidation, doesn't really matter. Bull markets are made of higher highs and higher lows. So the low part happens, even if we enjoy the seemingly endless ascents better, those ascents are punctuated by setbacks. And summer is a very common time for that. And it's almost perhaps a bit more marked near the beginning of a gold bull market because a lot of the a lot of the money that comes into play when gold turns is people who are really engaged with the sector. So long-time gold investors who've been waiting for this turn for the last 4 years, those of us who work in the industry who have also been waiting and know what this kind of turn can mean, right? That there's going to be some really nice share forms and majors, which was different from the classic playbook. But that's largely because the majors are still more burdened with debt. Like their balance sheets are not as strong as the mid-tiers who were able to repair those balance sheets better during the bear market. So we thought a bit of an interesting dynamic there. But regardless, anybody who was had gold production or silver production of reasonable size, their share prices went crazy, to put it bluntly. And then we saw that investor interest move down, and we saw, companies with development stage assets start to really get interest as well. And then we saw exploration stage companies, at least the explorers who were active in doing something. There's a lot who are still just figuring out how to get out the door because they were bereft of money for so long. But those who were active started getting all that interest as well. And we've seen it. I can point out a bunch of exploration stocks that are up sixfold on the year. So we did get the classic
100% move in silver, but we've seen these in the underlying mining shares. But this summer has shown to be, a correction period for some of these miners as of the last couple weeks here. So I want to ask you about the dynamics of, what we're seeing in the summer and kind of the cyclical nature of what we might be going into in September and into the fall.
Absolutely. Those are sort of the questions on everybody's mind who's interested in investing in this sector right now. So yes, clearly miners made huge moves off of gold's 25% gain. That happened in the first half of the year. And we absolutely saw miners double, triple, quadruple. And And we did see a fair bit of the classic order of events, which is that the first to go were those who were already in production, the sort of safer go-to producers. A bit of an interesting thing there were some of the mid-tiers outperformed.
Hello, everyone, and welcome into CrushTheStreet.com. I am Kenneth Amaduri, and today we have a timely discussion, we're going to have a timely discussion with Gwen Preston of ResourceMaven.ca. She's got powerful insight on the economy, but more importantly, mining, and she provides independent analysis of the resource markets, and today she's going to shed some light on all of this for us. She's a returning guest, Gwen Preston. Thanks for joining me.
Thank you very much for having me.
Gwen, since the beginning of the year, it's been quite a moonshot for some of these miners, 100%, 200%, 500%, 800% in some cases. And, here at Crush the Street, I've been telling people precious metals are essential going forward, in this unstable economy. And the miners offer that leveraged upside. Obviously, we haven't seen 100% move in gold, or even a
move, which is producers followed by developers followed by explorers, and then then summer comes, and things have been mostly sideways since the summer. So, what does that mean in the big picture? My view is that we are in a gold bull market. We have the fundamental arguments for gold are very strong. On a relative basis, it's still inexpensive, and in a broad context of where to put money that is both somewhat secure and offers upside opportunity, gold stands out. We're sitting in a world that's awash in negative interest rates, negative real rates. We're looking at U.S. stock markets that are expensive. Whatever you think is going to happen with those U.S. stock markets, the valuations are very high. We're looking at global economies that are pretty stagnant. Not terrible, but certainly not outperforming by any stretch. It all really adds up as a perfect storm for gold. So in general, we're